And let us also note that individuals are a couple of things: living longer and working longer than they ever have. Okay, individuals are living longer and working longer than they ever have. Retirement is not such a set thing as it used to be, or as maybe we still think of it as. Retirement is not just this set age at which, hey, I get to this point, I retire, I take my Social Security, I take my pension, I go home, because pensions are going away. That thought process that stuck around for a long time of, hey, I'll just work for 30 years, 40 years, I will, get my pension and go home, and that pension will cover me for the rest of my life. That really doesn't exist anymore in corporate America. I'm not saying it doesn't exist at all. I'm just saying on a wide scale, companies do not do this in the way that they used to. And this is important. And this is important when we talk about bonds, and it's important when we talk about investing for retirement. Because what that is forcing individual savers to do is to have more money prepared for retirement. We need more money in order to retire on, because now we don't have those guaranteed payments of the pension. And who knows how long we can, bank on Social Security being around and being well funded and being able to provide good, secure payments to individuals as well. And so, given that those things are, variables that are on the weaker side, especially the pension one, because those just really, really don't exist on a wide scale anymore, we have to save more. And in having to save more, you can do so in multiple ways. Well, one way is I can just save more money, right? I can just put more money away. And we talked about how putting more money away is the number one way in which you can have more money in your retirement accounts over time. And so that is obviously something you want to be doing. But in the same way, if I need to have more money in my retirement accounts when I am ready to retire, something I also need to do is be making good returns over time. It is going to not benefit me very much to take a super conservative approach and just sock money away into that conservative approach. We need to be accumulating as much as we can in our retirement accounts, especially our tax advantage retirement accounts, where we can grow tax-free or tax-deferred and grow our monies over time. And bonds are going to provide subpar returns to stocks. That is just the case. That has been the case over a long period of time, and my guess is it will continue to be the case over a long period of time. So what am I suggesting? I am suggesting that while you are working, that you keep a heavier stock portfolio, that you don't just dig into being invested in bonds and increasing your bond allocation systematically to a very high percentage of your portfolio by the time you retire. That is not likely to benefit you very much. You need to get the returns that you can while you're working, and you need to understand the stock market, understand the compounding of money over time, because we've talked about how the stock market over 10-year periods almost never has had negative outcomes over a 10-year period. And we've talked about the bond market also being extremely volatile in price as well. So if you're just looking at the value of your accounts over the long term, stocks are going to provide you better value. Now, none of this is me saying that bonds don't have their place. None of this is me saying that you should never invest in bonds. But what I am suggesting is that bond investing in your retirement account on a wide scale and doing it too early may not be a good idea. Now, what this idea of being more stock heavy or not as heavy in bonds is going to cause is it is going to cause you to have to deal with the fluctuations of the stock market. It is going to cause you to have to pay attention and have a cool head about the stock market. You can't just be looking and freaking out at the fact that things are volatile, or that the price of stocks fell off the face of the earth last March, or whatever it may be. You are going to have a cool head and understand that this is a long-term game. That is part of the reason that a bunch of people end up flocking to bonds in the first place, is because they have such a short-term risk-averse mindset. And they don't understand the stock market very well. And so they'll just run to bonds or even run to cash because they do not know, because they do not understand, and they are not willing to keep their money in something that, and I wouldn't be willing to keep money in something I don't understand either, but they're not willing to keep their money in something that fluctuates like the stock market does fluctuate. And when it comes down to it, what do people want? People want guarantees. They want returns without the risk that goes along with the returns. And I've told you before that it just does not exist in the way that you would like it to. And so we have to keep in mind that since we want certain returns, since we want to make sure that we can get a certain amount of money in retirement, then we are going to have to put a lot of money away and make really good returns over time in order to do so.